If you're an intraday trader, high volatility isn't something to fear, it's actually your best friend. So when the VIX is elevated, institutions are forced to take action. And when bigger players step in, they kind of leave these clear footprints in the price action. So that's what we're going to cover today. We're going to cover how to read those footprints and capitalize on them with 3 and maybe 4 powerful trades that usually work exceptionally well in high volatility markets. Plus, we'll kind of highlight a tool that we use that helps us spot these opportunities real time. But the things that we're going to talk about are why high volatility markets are better for traders. We're going to talk about the importance of identifying institutional price action, kind of following that big money, what those big players are doing. We'll cover the trade setups, the stuff scalp, VWAP continuation trade, midday reversal trade, and then even get into an afternoon continuation trade. And then, of course, we're going to wrap it all up with some key insights into the way we think about these opportunities. Before we dive into the trades, let's quickly talk about what happens when volatility spikes. So we use the VIX as a really good gauge. When the VIX is elevated and we use above 20, market makers, hedge funds, family offices, institutions, they're all actively managing risk. They're liquidating positions, they're hedging aggressively, they're putting on options positions as a way to hedge, and they're reacting to the macro events that are occurring. So this elevated VIX environment creates a high volume, high range set of moves that are much easier to trade, but if you know what to look for. So the key here is to understand that a VIX between 15 and 20 gives you one set of market variables and one set of trades that you can look for. With a VIX above 20, that's what we call elevated. A VIX above 20 is an elevated VIX environment. That gives us a different set of trades that we look for. And then if we ever get VIX above 30, that's an extremely high volatility environment. So we're going to adjust our trading accordingly. The trades that we're going to talk about today are really built for above 20 VIX environments. They're trades that you'll see in below 20 VIX environments, but really these are going to shine when we're above 20 VIX environments. And they really highlight the institutional trading activity that occurs during a heightened VIX environment, which forces position adjustments from all those hedge funds, family offices, big players, all those banks that need to move price action around. They need to get positions on and off, and they create these exploitable setups for us. Now that you understand why high volatility creates better setups, let's break it down into the 4 trades you should focus on in these environments. And these are specific trades that occur in a very repeatable pattern. So the first one is going to be the stuffed scalp. So this first trade, the stuffed scalp, is actually named for a trader on the desk. And we kind of coined this name out of a weird experience. So he was really good at trading breakouts. He was always looking for really good range breaks to the upside in lower volatility environments, in VIX environments below 20. But the stuffed scalp is something that came up, and it's one of the best plays when that volatility is higher. So throughout the day, you'll see institutions needing to execute large orders quickly. It'll create strong imbalances in the price. And if you can identify which direction the big money's actually acting, you can see things try and break up and out of ranges, or sometimes even down and out of ranges. But when the volatility is high enough, they might try and bust through a tiny bit, but then it's going to quickly turn and come roaring back down. So the trade initially got named when a trader on our desk was kind of enjoying a lunch we had brought in for the office. We have great food here in New York City, and in our midtown offices, we'll often order in, and that day we had ordered in Cuban sandwiches from like this really good place near us. And the trader ate 1, and then 2, and then 3 sandwiches. So you could almost tell that he was eating to kind of satisfy his emotional volatility, because the momentum breakout trades to the upside that he was looking for just were not working on that day. The VIX environment was a little too high, and he was getting a little frustrated. And maybe he had a little bit of a food coma too, but he was sitting there, and when a stock he was watching looked like it was going to break out, he was watching it, and it looked like it was going to do exactly what he loves to do, which is buy the breakout. He he was watching it, and then all of a sudden he kind of shocked all of us because he called out, "I'm short, here's my stop." And it was a little bit of a surprise because he just doesn't do that. That's not something he usually trades. Later, when I kind of bumped into him in the kitchen when he was, I think, getting another sandwich, I asked him kind of why the change? What did he see that made him go short instead of going long, what he usually looked for? And he said, honestly, that trade hasn't been working. So when I kind of saw it drive up there, but then saw the seller cleanly on the tape, I just went short when the seller stepped down and they cleared a buyer. And I was kind of shocked how easily it worked. It was just kind of a scalp, but it was an important one for his higher volatility environment playbook. So the key criteria to this is to look for a stock trading quickly up or down into a key level. And ideally, it's extending to that area from a gap or from like a grindy drive into a key area that then accelerates right into that area. So what it really looks like is this stock's about to break out. It's about to go crazy to new highs. The volume should be pretty normal, not super elevated, but as that move gets right into that key area, we should actually see this thrust of volume occur. And then we're going to just identify the key levels where big players have been active before. We're going to use basic support and resistance area. Then we're going to look for that clear and distinct movement into that area. And you can see it on the chart we're looking at. You can see a quick, fast move up right on the open, up into a key area, that 302.5, really above anything above 300. You can see us do that right on the open, and you see the immediacy of that turn and the response back lower. And then you see us drive up again. And what he's really looking for on that second drive up is it looks like the buyers are going to take it right through, but what happens on the tape is super interesting. It's like the buyers step up, and then there's almost like an air pocket that gets developed because the buyers push and push, but there's a real seller there. And as soon as that price action turns away from that, as soon as you start to see that red candle develop, as we try and push up and we don't, that's where you can take your short. Ideally, you're looking for the first time the offer steps down away from that level after this compression into the level has occurred. And then as the price action drops out, you're putting your stop just above the high of the area. And then you're looking for a 2-to-1 from wherever your entry is, right above that risk point. You're looking for a 2-to-1. And you're going to cover 70% of your position or 80% of your position into that 2-to-1. So let's go over the execution rules one more time. You're going to wait for that first drop of the bid after that compression up. And if you're not using the tape, that's still okay. You can wait for the first 1 minute candle bar to close away from that level. And you're going to enter when that price breaks down below, when you get that close away or when that bid gets taken out by the offers. You're going to take that 70% off at 2-to-1, and then you're going to move your stop immediately to break even, and then look at the potential for this turn into another trade if it continues to go lower, or you can just kind of trail it with a 2-bar trail, where essentially you're moving your stop down every 2 bars. So we wanted to use this example because we actually get 2 versions of it here. We had that first move up. You can see where the seller stepped in right on the open. We have that second fast move up, and people are thinking, that's on higher volume. This should break out. And what happens? It fails. It turns. And then you get that air pocket where it just like drizzles all the way back down. That's that trader sitting there just stuffed beyond belief and going, I'm not going to win long. I'm just flipping it short. And taking that trade, and it's really just a good scalp. Why it works so well is because in higher volatility environments, you see prices pushed in either direction very aggressively. But when they don't follow through, it's almost like these air pockets developed. We call it trading on a trampoline. In low volatility environments, when something comes into a level, it'll be like firm ground. It'll be like you're standing on firm ground. But in higher volatility, it'll feel a little bit more like it's trading on a trampoline. So you'll kind of push really, really hard, and then you'll get a spring back effect when it doesn't follow through. So you'll push really, really down, and then you get a snapback, spring back effect when it doesn't follow through. This is a really important trade, and there's actually a really good version of it later in the day too, on the same chart we're looking at. So if you can spot it, you notice how we try and break up into that 12 o'clock hour. You can see the increase in volume, that quick push higher, right into that same resistance area. And you can see how the bidders are stepping up, and it looks like they're going to break it through, but they don't. This isn't as fast of a turn back lower, so you really do have to wait for that failure. You need to see those bidders stepping up, stepping up, stepping up. And then there's that moment, that candle, that wick, where it wicks down and looks like it's going to break higher. Looks like, okay, the bidders have won. They're going to take it right up. But then the sellers don't lift. And the sellers not lifting is our first indication. The second indication is that time it drops out and then tries to rebid and can't. And then as soon as we start to see the sellers step down with the price action, as soon as we see those sellers continue to sell, they were big right at that level, and then they're coming in and pushing a little bit lower. That's where we can take this stuff scalp. That's where we can look for that 2-to-1, take off 70% of our position. If you're uncomfortable just learning this trade, take off 80 or 90% of your position at 2-to-1. And then just let that other piece trail, because a lot of times this sets up a cleaner move than you think. And it's a good best practice in higher volatility to just hold a little bit of your position until you're really stopped out. The second trade we're talking about is the VWAP continuation trade. Now, this is ideal for trend following in more volatile markets with that elevated VIX environment. It's a trade where you're going with the trend. You're not fading like we did in the stuff scalp. But this is a trade that showed up on our desk because Steve, one of the traders on our desk, one of the partners here, would always talk about when something made an absurd move in one direction that it's usually right off the open, kind of made a just really clean move right off the open and then had a quick and aggressive move back to VWAP. That was often a really good buy point because what it shows us is that really clean, aggressive move to the upside was actually a larger buy program. So it's somebody who's buying the stock and some institutional player. And then as the stock quickly comes back to VWAP, they're recognizing it's an opportunity for them. They're not going to chase price really far away from VWAP initially. They're going to let it come back in, and then they're going to let it come in and start to buy it again. Because basically, they're players that are playing on a totally different time frame, and they're playing a little bit of a different game than what we play. But in higher volatility environments, they're actually playing that game with us. Now, a key component of most of these higher time frame players they're pretty good at not forcing risk. They're pretty good about not forcing risk, and they're really good about letting things come to them. It's like they're the players on the basketball court who are just constantly moving around and look like they're running all over the place, but in reality, they know exactly where they're trying to get to. Now, you can kind of see these players all the time. They're running around setting a pick, and then they're rolling off the pick and maybe just hanging in the corner for a minute. But as soon as the ball kind of moves into a key area, they get right to the spot they're looking for, and they look to take a really high percentage shot. For the big players, that high percentage shot is often the price action right around VWAP. Execution desks and usually a lot of large algos rely on VWAP as a key variable in entering their trades. They want to buy above that volume weighted average price, that VWAP, across an entire basket of stocks. Not just one stock. We're watching one stock, but they're doing this across an entire basket of stocks. And they're going to sell if the price is below the volume weighted average price, again, across a basket of stocks. So they might not even be thinking about what's this stock doing relative to VWAP. They might just be putting in an order that we are buying this above VWAP and we are selling this below VWAP. So we can use that as a piece of information because when a strong stock makes that distinct up move off the open and then has a really clean, aggressive down move into VWAP, we can look for a moment where the buyers kick back in and they present us with this tremendous trading opportunity for us to take advantage of. So let's observe the key setup characteristics for this trade in a higher volatility environment. The stock has to make a strong trend up in the first 30 minutes if we're looking for that VWAP continuation long. And then the pull into VWAP has to occur with decreasing volume. A little pro tip here is when VWAP lines up with a key area, key support or resistance area, in this case you can see it almost dead on lines up with 300, you can really look for this trade to work very well. What you're looking for to enter the trade is when the volume weighted average price spikes down to VWAP, and then almost immediately we see the buyers kick right back on. You don't want to see much hesitation. Occasionally you'll see a little leak through, and you don't want to enter it there. You want to wait for that buy program to kick back on, and you want to wait for price to start moving aggressively away from VWAP. Now your stop is going to go below the most recent pullback low, which oftentimes is at VWAP or just below VWAP. And you're going to set a profit target of the previous high of day, where that first pullback started from. You're going to take profits there because that's kind of that next potential area of resistance. You're going to sell half right at that area, and then you're going to trail the remainder of it using a measured move of that initial move, right? So that first drive up, you're going to take a measured move of that first drive up, and you're going to add it to where the entry was and look for that exceptional measured move on that second leg. It's going to be crazy how often you'll put your target there and you'll get this like spray into that second measured move. This is exactly why we pulled up this chart, because this is a textbook VWAP continuation trade. So you can see we pulled in right on the open, but then look at how sustained that buying pressure is. The buyers were really aggressive up there. They were driving it higher. And then look, if you observe closely, once we started to trend a little bit lower back down towards VWAP, you see a low volume pull in. And then you see us wick down into VWAP. That VWAP lines up right with that 300 area. As soon as we see that buy program flip right back on, we can enter long with our stop just below that low. We had that real sustained buyer coming in off the open. They dropped for a little bit. We kind of methodically and quickly made our way back to VWAP, and then we saw that buyer kick right back on. If you do not see that buyer kick right back on, you do not have a trade. You have an idea of a trade. And you can easily invent this trade if you don't see that buyer coming back right away, and they should be coming in a very distinct manner. But if you do, you actually have a trade. Your stop goes right below that low of that wick or VWAP in this case, and you're looking to exit half your position as it clears to the highs, and then looking for that full measured move of that initial up move as your second target. You ideally want to see an increase in volume as the price is breaking up above that prior pivot high, or whatever you want to call it, that prior high of day. It's ideal when that volume comes in because we're seeing that order flow really accelerate at that point, and it should be a really good version of this trade. It happens in both directions, but that VWAP continuation trade allows us to participate in these moments of opportunity when there's a big player present in a more volatile environment. Remember, more volatility means you have to fight for price a little bit better. You have to be a little more aware of the times that the buy program kicks on or the buy program's not there. So just give yourself the opportunity by understanding this trade and seeing when it flips right back on. The third trade that we're talking about today occurs during the midday. And the midday is usually a little bit slower, but in high volatility environments, reversals can usually offer us incredible risk reward opportunities in the midday. Now, what's happened in the midday oftentimes is there's an attempt, there's this push higher through the open or push lower through the open. But in high volatility environments, especially volatility in range environments where there's a lot of volatility, but we're not actually moving anywhere, what you'll see is you'll see institutions start to force into one area. They'll force it to the upside. And then they'll stop getting rewarded. And when they stop getting rewarded, guess what happens? Then it kind of snowballs on itself, and then throughout the day, it kind of unwinds. Or they'll push it really aggressively down to the downside, or really methodically down to the down, as if we're going to break to the lows. But then we'll start to catch a bid. and it'll methodically start to build and build and build, and then all of a sudden this rally occurs. So the same thing happens in both directions. And we're going to look at a short example because it was just something that happened so recently. And what we're going to look for is actually a series of events that allow us to take this trade. So we have that first press higher in the market. You can see we try and press up, and it gets a little choppy. You see how we try and make a new high and then fail, and we pull right back into VWAP, and it looks like, oh, maybe we have a VWAP continuation trade. And then that fails as well, right? So we have a series of lower lows and then lower highs that begin to get put in. This isn't just this methodical, like crazy amount of selling that just like turns down and then goes crazy. This is actually, it looks like the buyers are going to keep trying to push it up. But every time they step in, instead of getting rewarded, they're starting to get punished. In higher volatility environments, there are going to be traders who are betting on the direction of a stock for the day based on a basket of stocks, based on a bunch of different criteria. But as their bets take more and more heat, they get rewarded less and less. They're a lot of times actually going to have to flip their bias and go from buyers to being pretty aggressive sellers so they can manage their risk. So what you'll see is price will actually get down below VWAP. The 9 EMA will catch up and then cross VWAP to the downside. And that's where you can take your trade. You can enter short when the 9 EMA crosses VWAP as long as you have those other criteria. I understand it's like 3 steps on the left side of the chart, but it puts you in such a high probability situation when you have that. But you take that 3 steps on the left side of the chart before your entry. You enter when the 9 EMA crosses back below VWAP, and you can risk a third of that range to the highs. So you take that measured move from the cross to the high of the day, and you cut it in 1/3, and you add that to your entry, and that's where your stop goes. And what you're looking for is that total momentum shift, where it's like the buyers tried to get rewarded, and then tried again, and then tried again, and they just got rewarded less and less and punished more and more for trying that trade. When they're really taking heat, that's where we want to be in that trade. That's where we want to enter with a clearly defined stop and look for a fast and sustained continuation move lower. We're actually going to target the full measured move from our entry to the high of the day, just flip to the downside. So it's this fashionably late scalp, but it evolves in a really particular way for midday reversal trades. It also sidesteps that challenge of what do we do trying to catch a top. That's a really dangerous game in high volatility environments, trying to catch a top, especially on a midday push higher, because sometimes you just get this crazy spray that turns into a stuff scalp that you weren't prepared for because we were waiting for it. So you just kind of allow the traders that have pushed in one direction all morning to take in more and more heat, to really get punished more and more for the buys that they're making. And then when it flips, you just take advantage of that as an intraday trader. In this example, you can see exactly what we were talking about. You see that drive higher, and probably until about 10:15, it looked like we were really going to have a nice breakout. And then at about 10:45, man, that's odd that we just couldn't make a new high. And then you see how quickly we pull back to VWAP when we break for that backside scalp. We get to VWAP, and what happens? There's a little pause, and then there's a minute that looks like a VWAP continuation trade to the upside. But then the buyers that stepped in there just don't get rewarded in the right way, and we see a clear and distinct turn, and then we get back down below VWAP. That's where it's like, oh man, this trade could be on. We could actually be watching a midday reversal. So we let the 9 EMA catch up. When it gets below VWAP, we can enter. We can put our stop a third of that range higher, and then we wait for the price action to turn in our direction. When we have that cross and the turn and that combination of things, what should happen? The buyers aren't getting rewarded anymore. This stock should just unravel, and it does so many times. And it's really interesting because you'll see this happen in individual equities. You'll see it happen in the markets as well with those midday reversals. You see it happen in futures all the time. But remember, it's a series of events that occur on the left side of the chart before you get your entry criteria. And then you should expect the right side of the chart to be actually pretty clean in your direction. So this final trade's an afternoon continuation trade, and actually we call it like above the clouds. That's the kind of nickname around here because one of the guys here took this amazing photo of this moment in his life where he was standing above all the clouds when he was hiking a mountain. It was really, really cool. I shared it with a lot of us. And I was like, oh, it's like you're above the clouds. And so we kind of named this trade above the clouds, but it's actually an afternoon continuation trade. So if an institutional moves strong enough, it often carries into the afternoon session. There might be some sustained buying early, and then there's urgency that picks up. The key is finding kind of a stock that's already traded well, and it's consolidating near the highs or near the lows if you're looking for the downside on this into the afternoon. We're using VIX as an example in this chart, the VXX, which is the tradable VIX product. We're using it as an example. You could actually look on the same day at SPY and see the polar opposite of this trade, but we wanted to highlight how VIX moves because when we talk about an elevated VIX environment, you actually want to be very aware of the way VIX moves and how aggressive and sustained the moves can be, especially because they correlate so much to the aggressive moves of the S&P, like the ES or SPY or Qs or any of the big market indices. So when you see VIX making an aggressive move, you can usually look over and see the indices making a correlated but inverse move. Ideally, you want to see a stock that's respected VWAP and kind of held up all day long. And then you want to start to see an afternoon range contraction right near the high of the day for a long or the low of the day for a short. And then you want to see a breakout that occurs with increasing volume later in the day. This is a pretty straightforward pattern, but there's a couple nuances that a lot of people miss. So let's get into the trade. So you can see how this stock has made a sustained up move after 1:30. That's usually the time we start thinking about afternoon trades. But then it put in this choppy kind of not really a great range. It's not really that defined initially. It kind of rolls over, but then gets rebid and then has this choppy consolidation and then tries to roll over again. That's actually a great trait of this trade. When you have a little bit of that price movement occurring, it becomes so much more clear when you have real participation, not just in the volume, but when you look at the left side of the chart, you can see how there's just a lot of basically feeling it out occurring. And then you can see the difference when there's sustained buying that occurs. That sustained buying is what we're looking for to give us this trade. Ideally, we want that entire consolidation to occur above the cloud cover of the day, like outside of the range of any of the other price action. And we're okay with it being volatile because we're not going to enter without a clearly defined entry signal. And that entry signal is going to be a breakout that occurs on elevating volume. Elevating volume, not just elevated volume, but elevating volume. We want to see that urgency pick up on the part of the buyers. And this is a great trade for higher volatility environments because you'll have large institutions that need to get positions on or off into the close. They're afraid of the overnight risk. Pretty much everybody is in a higher volatility environment. And so you'll see people with an elevated sense of urgency to get their orders, their big orders, in or out before the close. So you're going to look for this pattern. Again, you're looking for kind of that above the clouds where there's that consolidation outside of the prior range. You're going to look for price action, just kind of be chopping around, and then you're going to look for something different. And you can observe how different the buying pattern looks on the chart, and it's even more prevalent on the tape because you'll see the buy program kick in and then start to hold above. So we're going to enter on the break of the highs, and then so often there's this little 3-bar pattern that occurs where it's like up, big candle, down, small red candle, and then it looks like it's going to drop out, but then there's a green candle rebid that occurs. Once that happens, you go from this maybe sense of apprehension about the trade if you've bought that, like, oh crap, maybe it's going to fail, to almost a sense of relief as the trade starts working for you. That sense of relief is actually an opportunity to add to your trade because that sense of relief occurs when that trade has a higher probability of working very, very cleanly. And what we're looking for in this is actually a really aggressive extension. You're looking for price action to just truly accelerate. So your stop is going to go below the low of the consolidation. And then when you get that moment of relief, right, where price pulls in and then pops right back up, your stop is going to go to break even. Yeah, your stop is going to go right to break even on that because there's no reason why that trade should come back against you at that point. So you've basically taken risk off the table and you're trying to look for a real accelerated move. And the only two ways these moves end is typically with real acceleration or the end of the day. Those are kind of your reasons to sell. And it's really the best when it occurs with real acceleration into the end of the day. You have to put that trade on knowing I'm either going to get stopped out and probably break even, or I'm going to be holding this trade into the close. And you want to make that commitment to yourself because in higher volatility environments, you can get some crazy closes. And there's nothing that feels better than ending the trading day by recognizing an opportunity, stepping into it, and holding it until the close where you catch some crazy acceleration and your P&L just ends at the highs of the day. It's a great feeling, and I wish everybody could experience it every day. We don't get the opportunity to every day, but when you do, take advantage of that opportunity. So here are the 4 most powerful trades in high volatility environments, just summed up. You've got the stuffed scalp. You've got the VWAP continuation trade where you're following the trend and re-entering when you see that trend continue. You've got that midday reversal trade where you have all those 3 components set up for you, and that gives you permission to take that fashionably late to the downside. And then you've got that afternoon continuation trade, that above the clouds price action where you're riding that aggressive buying into the close. If you want to see these setups in real time, you can actually check out the S&B Scalp Radar. There's a webinar that we give you cheat sheets that kind of go along with a lot of these. And the radar is a tool we use to kind of track that momentum and those liquidity shifts that are occurring. And we use those through discrete trades that get presented to you. So there's a link in the description where you can learn more. And you can drop a comment below. I'm really curious, what's your go-to trade in high volatility?